So I'm James Saunders, I'm the CTO of RelyComply and one of the founders.
And I'm Elliott, and I'm the CEO of RelyComply. So RelyComply is an anti-money laundering and KYC platform built specifically for enterprise financial services businesses. What that really means is that we've taken what historically has been very different kind of business processes as part of the anti-money laundering compliance journey and really put them into one unified platform for our customers. I think there are two key contributors when you're talking about big regulatory shifts this year. One is like the geopolitical situation, and the second is how that has affected regulation, so call that. And then the second is actually just regulatory shifts. So, I mean, globally, and maybe just focusing on a few of the markets we're in, like the UK and South Africa. In the UK, there's been a few things like the FCA this month, July, redefined what the FCA in the UK redefined what a UK PEP is, and they actually said that UK politically exposed people were lower risk than others. So there's this kind of reclassification of looking beyond just generalizing across like regulation and your definitions. That's one thing. And then next month, in September, they are introducing the failure to prevent fraud offense. And what that really does is that's like the second most impactful act since the Bribery Act. And what it actually does is, I don't know how much you know about it, but what it actually does is it can hold the board members of companies accountable, and the fines are unlimited. So there's no threshold on fines that can be imposed on those companies. There is a definition of what companies qualify under this act, and they tend to be like slightly larger, like more than 250 people as an example, on a certain revenue turnover. And then I think the third big change in the UK, or the third big shift in the UK that we've seen, is just absolute increased enforcement around, like enforcement of regulation in terms of fines, especially around fraud and anti-money laundering. So Barclays being fined £42 million, Starling Bank being fined, I think, £27 million, and there were a bunch of others as well. But also with the Barclays instance, it was that this is like their third offense in 10 years, and how the fines have just like ramped up significantly. Yeah, there's a few thoughts in the UK, and then obviously South Africa, we could probably talk about grey listing.
Yeah, I think my views in terms of regulation, there have been sort of three movements, and they are a bit contradictory. One, we've seen a lot more enforcement. Simultaneously, we've seen a bit of a loosening of some of the expectations. So we've seen that obviously in the US, where Foreign Corrupt Practices Act was dropped, or at least they said they wouldn't enforce it. In the UK, we have seen a more nuanced view on your risk categories in your PEPs. But at the same time, we've seen this massive push to actually evaluate your risk across your entire customer base. So we're looking at all your UBO information, we're looking at periodic reviews, and just a huge amount of money that companies have had to spend on these, and often very manual processes. And then beyond that, especially in Sub-Saharan Africa, a massive increase in enforcement. So while the rules are a bit more nuanced, violating them, and to your previous point, the Failure to Prevent Fraud Act is a great example of this, where there sometimes is a bit of a lower threshold, but if you don't meet that threshold, you're in trouble.
Yeah. I think it shifted from, and this is maybe not even in the last year, but before, from a kind of, I wouldn't say like advisory kind of watch, and it's definitely moved more to enforcement, like you said, as opposed to like, what's the right term, like oversight. It felt like regulation very much used to be checkbox and oversight. Now it's much more like enforcement based. That's definitely like the feeling we're getting globally. I mean, obviously, like you said, the nuances, like in the US versus the rest of the world maybe, but yeah.
The US versus everyone else.
Yeah, basically, yeah. Yeah.
Yeah, I think because of that, because there is a lot more enforcement, and that is international bodies having a lot more teeth, that is local bodies having a lot more teeth. That has also there's been pushback by industry to make sure that these rules are sensible, that they actually do matter, that you aren't doing things that are very pointless and expensive exercises, especially if you're going to be at risk. So we've also seen, and I mean, this was adopted a few years ago, but really is starting to mature now, the importance of risk-based approaches, the importance of really understanding your risk from a fraud and AML perspective, and a much more robust engagement from the regulators about what that actually means for you. But that has also meant that you've got to be a lot more dynamic in your processes, and there's a lot more expectation that your processes are dynamic.
Yeah, and a lot more scrutiny on companies. I think if we come back down to the question of like, what does it actually mean for companies at the end of it is, I mean, like in South Africa now, the FIC and PAA have to, like, after grey listing is, they have to meet quarterly, as an example. So you're going from this kind of like annual audit to almost quarterly audits, which are quite intensive on a business. And then, yeah, I mean, of course, the usual systems or technology, people, processes, there's a lot of investment that's happening, that's needing to happen there. And what is the narrative we're hearing globally as RelyComply is the cost of compliance, and how do they manage the cost? Because ultimately, that cost has to go somewhere, and it's either going to eat into margins, but most of the time, if we're honest, it's going to probably get passed on to the consumer, right?
It's only investors or consumers that ever pay for something.
Yeah, exactly.
But yeah, had a very good point. Yeah, the other big shift that we're seeing continuing is how many more parties are coming under regulatory purview, where it was really just core financial institutions, really banks. Now pretty much everyone that touches money in some way has regulatory obligations. This makes complete sense. There's no point in super armoring just a few doors and then leaving the fence dilapidated. But this is difficult for a lot of companies, especially as we get more interesting, more diversified financial services providers. The cost of compliance is real and difficult. So,
yeah. And you've got to, I mean, like, this is probably going off script a little bit, but maybe a little bit more philosophical. Once again, it's like, do they really want to stop this? We've got a super interesting story from the weekend where, like, someone I met was like, you know, they know someone who was like, had commercial property, and basically a politically exposed person bought a commercial property from them, but wanted to pay in cash. And they were like, well, if the conveyancers cleared them, then this is the conveyancer's problem. I'll take the cash, because the conveyancer is actually the one who's, you know, who's legally dealing with this from a anti-money laundering perspective. So although there's all these additional costs and checks, we need to start seeing, like, what is the efficacy of them down the line. Yeah.
Oof.
AI. I guess there are definitely a few places, right? Like, you got to look at, like, RelyComply. You got to look at, like, the I think better augmentation of data, like looking at, you know, to assess risk of a person that you're doing business with. Seems like, you know, if you're getting that all kind of holistically and integrated into a single place, that becomes quite powerful. But it's probably a lot on the transactional side, I guess, right?
Yeah, I think a lot of your sort of traditional criminal typologies are becoming much more difficult as there is a lot more automated transaction monitoring. The idea that people were getting away with just eyeballing things on spreadsheets it's now just not allowed, as well as just being infeasibly expensive
and inaccurate.
And yeah, just bad. I mean, where technology has done the most for financial crime is definitely in the synthetic identity deepfake space, which, I mean, is very much an arms race and difficult. but that's definitely, going to be a massive future problem. It's a massive now problem, but it's definitely going to be a massive future problem. And then ultimately, I think it is building these systems into the basic product design of financial services, especially because what we're seeing is these sort of interesting parallels where often as a financial services product, you are trying to assess risk in the good sense that you want to give someone a product and you hope, they either give your money back or never ask you for money again, depending which side you are. I think there's an interesting mix in your fraud signals and your AML signals that are essentially the opposite of that. This is an untrustworthy person. And where that starts to combine together in both your product design, whether you're creating a little bit of friction in that, but quickly understanding where you don't want to create friction for someone because you want to make sure you make that sale versus where you want to introduce friction because there is some sort of risk there. I think
have a better experience downstream.
Yeah. There's a lot in that, and I think rather than viewing this as a complete back office afterthought function, building it really into the forefront of the thinking of what is your service offering is where we're seeing huge amounts of value.
Yeah, and I mean, I think just touching on that, because I touched on it earlier, you were in the room, but the shift from compliance as a barrier to an enabler, like actually, and even further into a competitive advantage, if you build it into your kind of product design, maybe just the less kind of sexy stuff like AI and criminal typologies is like, with the right technology in place, you can create a huge amount of efficiency within your compliance teams so that those people can actually spend time, investigating and solving potential financial crime that is actually like probably more relevant than just working through a bunch of false positives as an example. So I think there is like that real world kind of automation layer, fully kind of single view of customer through compliance that does actually lead to a ton of like redeploying humans where they should be used as opposed to not be used. And then, like we said, also just being an enabler. Like you look at customer onboarding journeys through that automation, having a really solid customer experience, but like you said, introducing friction if necessary at the right points.
I think let's talk about payments and talk about how, while with so many new market entrants, margins are very thin. So automation is very important, but also as you are opening up so many more payments channels, you are much more exposed to fraud and how we've had experience in shutting down.
And just the clear volume of payments.
Yeah. Shutting down syndicated activity around that.
Onboarding journeys?
Onboarding journeys, definitely making that
super frictionless
while protecting against this massive rising threat of synthetic identities.
And actually, once again, the competitive advantage there and the revenue increase from quicker onboarding. If you look at it from a regulatory perspective, obviously if we're moving to more of an enforcement-based set of regulation, leaders actually need to start being a lot more like conscious of that, because they are going to be held more and more accountable as they go forward. And I think that pressure is just going to, like, depending on where you are, going to only pile up, right? Like increase. So that's a big thing. It's like, how do you have this kind of horizon of what's coming from a regulatory perspective, and how do you prepare your business for it? Because you don't want to become unstuck from both a technology perspective, but also a risk perspective. And that speaks more to the regulation than like what's happening on the ground from a fraud and like criminal typology perspective. That's definitely one that comes to mind for me. Like leaders need to be future focused, but also with them being held more and more accountable, they need to be not scared, but they need to be realize that aware of the risks that are involved.
Yeah, and I would say with that, a lot of the expectations around these spaces were fairly static for a number of years, and you sort of thought you had solved the problem, but that has not been the case in the last 5 or so years, and that is certainly not going to be the case in the future. So you need partners that are nimble, flexible, and can truly appreciate your risks and your business, and are prepared to get through those with you.
Yeah, and when you talk about nimbleness and flexibility, also from our perspective of the technology, the ability to keep up with the increased change in regulation, but also like true financial crime. You want to cover for both as a business, ultimately. But I'm going to keep going back to this thing of using the technology as a competitive advantage, like seeing it as an enabler is, I'm going to keep driving that because I do think it's important, where it was historically seen as a cost center. Probably going to see a lot more collaboration in the space, like between regulators and businesses, whereas before it was very much like checkbox stuff. Now, like you say, with a risk-based approach, you have to understand your risk, but also opportunities that this technology can provide. So if you think about some of the customers we work with, about getting to that golden state of risk across your organization, but once you've assessed a customer's risk, how you can actually flip that on its head and not look at it at risk, but from a commercial lens of, I understand this person is no longer risky or is low risk, and they could actually really benefit from XYZ product that we have in our offering, or we could offer them a bigger credit limit or whatever it may be. So actually using, and again, compliance to almost cross-sell and upsell product, which would have been quite a radical thought a couple of years ago, I think. RelyComply, RelyComply has proven, or we've proven that we have the ability to shift large financial enterprise businesses, or shift their compliance function, into a much more competitive space. That's not really what I want to say. What I really want to say was we've actually proven it. We've done it with big banks. We've gone into, we count the biggest bank in Africa as one of our customers, and we have onboarded 40 plus products across 12 different countries in our relationship with them over the past few years. And just that level of agility and the ability to keep up with the pace of change and demands that they're getting faced on a continuous basis from a regulatory perspective, I think speaks volumes. That's just one customer. We can go into the technology that underpins all of that. But really the proof is, we've got real referenceability in the market, and we are trusted by some of the biggest financial services businesses on the continent.
Yes, I think from a technology perspective, one is you have to accept that your customers' products, their financial service products, will be at different levels of maturity technologically. It's very important that we are happy to work with your traditional businesses where compliance can be seen as more of a back office function, but also have the flexibility and agility to directly integrate with your next gen, digital first, AI first applications, being a part of your application stack rather than some completely separate function, and then be able to unify those into a single view where you can feel safe that every compliance point you should be meeting, you are meeting. Then once you have that, being able to bring in trusted, explainable, observable machine learning and artificial intelligence that not only gives you comfort, but can give the regulator comfort, can give your various auditing departments comfort that there is reasoning and understanding behind these automated decisions, and then ultimately both reducing your risk and increasing your efficiencies.